Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month nickel, zinc and tin. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
LME 3-month nickel. The break higher during Christmas week, up over the gold long moving average, which is currently at 15,615, as well over the key levels of 15,665 and 15,840, saw a significant release of bullish energy that had been pent up for about 2 years. So what has this move up left us with? Well, as I said 3 weeks ago, and it's a long piece I'm afraid, and I quote, we have 4 features to watch out for. The first was the possible double top that now might be a possible triple top formed over January. This pattern depends on one key factor, whether or not prices can drop down to the low zone of 16,835, seen 3, which is now 6 weeks, seen 3 weeks ago. And then after that, whether the market can press lower or not. At the moment, this seems unlikely, but it's still one to watch. The second is to consider if prices try and get down to that 16,835 zone and fail, we might then have to regard the whole December 2025 to date action or any part therein as a possible bullish halfway hesitation. This is another thing to watch. Thirdly, we had a crossover seen 3 weeks ago, so that's once again 6 weeks ago, of the rising green short medium moving average, currently 16,690, the mauve medium moving average, currently 15,965, and the gold long moving average, currently 15,615. This is a bow tie formation, and the moving averages have gone in and exited out in the right order, with a bullish tinge about them. Consequently, we need to look to the future, and that means that between 15 to 20 sessions after crossover, we can look to see one or more of the following: a change in trend, a reinforcement of an existing trend, volatility. Thus, please pay special attention to this window between the 29th of January and the 5th of February, as that is the window. The final feature is whether to regard the whole January action as a possible ascending wedge pattern. I cannot give an idea of directional targets either above or below, but I can give an idea of the potentials involved. Thus, for a confirmed break lower, we would have a primary potential of plus $1230 for the break, and a secondary harder to reach potential of plus $1950 for a confirmed break, plus $1950. For a confirmed break lower, we'd have a primary potential of minus $625 from the break, and a secondary harder to reach potential of minus $1950. Please be wary of, as any break higher or lower may first be a false break before a true break occurs. End of quote. I'm sorry it's a long quote and not all of it applies now, but as you can see, the market chose the ascending wedge pattern idea for break lower late 3 weeks ago. This gave a primary target in the 17,400 zone, which was reached the same day, but a harder to reach target X1 still down in the 16,075 zone. I also added on this point the following last week, and I quote, now, this secondary target may be unobtainable for this pattern, as the action over the last 2 weeks can be one of 2 ways. It could be a possible horn bottom, in which case we'll be looking higher, though as yet the market has not triggered the appropriate level up at 17,680, or it could be a possible bearish halfway hesitation with considerable distance on the downside. But again, the market has not triggered this level down at the 50% Fibonacci line of the 2025-2026 move at 16,515. What is interesting is perhaps, just perhaps, the market is not that interested in doing either right now. End of wait and see. And that's the end of the quote. Sorry, again, it's another long one. Well, things are a little clearer, as the idea of a horn bottom can best be described as a fully constructed horn bottom that failed in the middle of last week with a pipe top. This leaves us with the idea of the bearish halfway hesitation, But here, well, we haven't failed, not yet, but we haven't triggered the pattern either, as we have stayed above the 50% Fibonacci line at 16,515. Additionally, we may be running out of time to hit the trigger as well, as we have the green short-medium moving average, currently 16,690, moving up swiftly to meet the market. I suspect we'll see an outcome by the end of February, which isn't really that far away. LME 3-month zinc. There had been here, and still are, a number of patterns affecting the market in recent times, all happening at the same time. The first has been, and I suppose still is, the dark blue mid-July to early October 2025 bull channel, currently 31.47 to 33.59. This captured most of the action since July last year through to really January this year. It has been breached a number of times, though the market still will not let go of it, as today's prices are back down below the broken upper dark blue channel line. The second pattern is the bright red May 23 to April 25 bullish Andrews pitchfork, and especially the middle time, currently at 33.50. This is the core bullish pattern here, and as it halted the rise 5 weeks ago, along with the dark blue upper bull channel line. This breach higher was also capped, sort of, by the two 50% Fibonacci lines of the March 20 to March 22 move at 33.29 and the 50% Fibonacci line of the April 22 to May 23 move at 33.77. Indeed, you could say it helped erode the bullish incentive enough to form another pattern, possible pattern, which I will detail shortly. Meanwhile, a third pattern emerged that became evident 3 weeks ago, and that is the bright green mid-December last year to date, imperfect but seemingly valid, though I don't know how much of it is today, the bright green steeper bull channel, currently 32.76 to 34.82, which seemed for a while to be taking over the running of this market higher until, well, today, when prices have pierced the green lower bull channel line. I will watch this part very carefully now. Now, I also spoke about another newer pattern just now, and that is to regard the whole late January to date action as a possible, very, very lopsided double top pattern. It's a bit of a squinty eye thing, but you could see it as such, sort of. If this is to be the case, and I am at this moment far from convinced, then I could just about indicate some potentials on the downside for such a pattern. Hence a primary potential will be down in the 31.38 zone, for secondary harder to achieve potential down in the 30.66 zone. These depend on one thing, and that is a true crossing of the neckline of the lopsided double top pattern. And that is an issue. As do I look at it as from 32.62 or from 32.38? And do I take measurements from the first high at 35.75 or the second at 34.58? I have chosen, for now, to be conservative and take the highest low and the lowest high, though I reserve the right to change these if we see prices aggressively move lower to reflect the opportunities. LME 3-month tin. We had a gapping move higher in mid-January that started the whole huge move higher. The rise was fairly swift until the market breached the previous all-time high seen back in 2022 at 51,000. The day after this happened, the market started to fade. However, prices turned back higher just after mid-January, and we rose up to reach the one big old pattern still even now dominating the market. The bright red upper time, currently at 58,230, of the big old 2020 to 2022 bullish shift pitchfork. This was tested twice, but held as resistance 3 weeks ago, which is very telling for a pattern that is between 4 and 6 years old. Now, 4 weeks ago, I said about the future movements here, and I quote, "I think there are two courses for this market to go. First is to try and replicate what we have seen in other metal markets, move up and try and form a possible double top. In this regard, I think the market is a little late when compared to other metals, and I think even possibly too late for such a pattern. But we shall see. The second is to fall back and fill in the gap left in early January below between 45,780 to 46,255, and then decide what to do. End of quote. I also added 3 weeks ago, and I quote, "There is a third way, and the market has seemingly chosen to strike for that. And that is to look at the whole mid-January to date action, indeed the whole late December last year to date action as a possible very large bullish halfway hesitation." End of quote. And indeed, 3 weeks ago that looked like the way it might go. However, since then, yet another pattern, a fourth pattern has emerged. And this one seems to be the key dominant short-term pattern here, if perhaps a little unorthodox. It is a possible January to February based head and shoulders top, a quite large one, and one that has possibly a pair of shoulders, labelled S and S2. This pattern depends on one factor, and that is the dark blue neckline for this pattern, currently at 43,890. This needs to be broken on the downside to become a head and shoulders top, or it needs to be rejected to form a rarer head and shoulders continuation pattern. We are close to doing so, indeed we are close to doing so 2 weeks ago, but we still haven't managed it. Though the latest market moves yesterday have seen prices close below the green rising short medium moving average, currently at 45,935, and today we are once again below this moving average. I suggest only a move up over the 2022 high at 51,005 would negate this pattern idea. But as we haven't broken the dark blue neckline as yet, I cannot give targets, and I am loath to give potentials below, as I would like to see the action around that dark blue neckline so that I can see where we stand. I'd just like to recognize one possible support out there that might affect any moves lower, and that is the bright green July 25 to date based upper bull channel line, currently at 42,695. This was broken back in December, but has been used as support since the break, so it's worth paying close attention to it, especially as any potential moves lower from the proposed head and shoulders top could be quite large, even for just a primary potential or primary target.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.